We are exactly 13 days away from one of the most anticipated earnings reports of the year. And if you position yourself correctly right now, you could be looking at a significant opportunity. But here's the thing, most people won't tell you. This isn't just about buying and hoping for the best. This is about understanding what's actually happening beneath the surface and making informed decisions based on real business fundamentals, not hype. I'm going to walk you through 3 different opportunities today, each with its own risk profile and potential reward. Stay with me, because by the end of this video, you're going to understand exactly how to approach these situations, whether you're a long-term investor or someone learning to navigate earnings season for the first time. And if you're new to Market Authority, welcome. This channel is all about cutting through the noise and helping you build real wealth through patient, intelligent investing. We don't chase trends here. We focus on value, timing, and understanding businesses deeply. If that sounds like the kind of content you need, go ahead and subscribe right now. It helps us keep bringing you this level of analysis every single week. So let's start with what's coming on February 25th. We're talking about Nvidia. And before you think this is just another Nvidia video telling you to buy or sell, hold on. What I want to do is walk you through how to think about a company like this ahead of earnings, how to evaluate whether the current price makes sense, and most importantly, how to position yourself in a way that protects your downside while still giving you exposure to potential upside. Right now, Nvidia is trading around $188 per share. The stock has been moving sideways for the last 6 months. And that's really interesting because when you compare it to other names in the market, you start to see some fascinating patterns. If you look at Robinhood over the same 6-month period, the stock is down about 25%. That tells you the fintech space has been under serious pressure. Now flip over to Tesla. Tesla has had very strong performance over that same time frame. The market is clearly rewarding companies with clear growth narratives and execution. But Nvidia, it's been consolidating, moving sideways while Robinhood drops and Tesla rallies. That sideways action tells you something critical. The market has already priced in a lot of expectations. People know earnings are coming. They know the numbers will be strong. The question is, will those numbers be strong enough to push the stock significantly higher? Or are we looking at a beat that doesn't move the stock much because it's already baked in? This is where understanding price versus value becomes essential. You can have a phenomenal company, but if you pay too much for it, your returns will disappoint. Your job as an investor is to assess whether the business is worth what you're paying today and whether there's a margin of safety built in. That's the foundation we teach here on Market Authority. So let's dig into what makes Nvidia such a compelling business. Nvidia is not just a semiconductor company. It's the infrastructure provider for the entire artificial intelligence revolution. Every major AI model, every data center running machine learning workloads, every cloud provider scaling AI capabilities, they all depend on Nvidia's graphics processing units. The company has built one of the strongest competitive moats in technology. A huge part of that moat comes from something called CUDA. It's a software ecosystem with over 4.5 million active developers. Once a company integrates CUDA into their operations, switching to a competitor becomes incredibly expensive and disruptive. That's the kind of structural advantage that creates long-term pricing power. But here's what most investors are completely missing right now, and this is where the real long-term opportunity lies. Nvidia is aggressively pushing into physical AI. Let me explain what that means. Right now, when we talk about AI, we're mostly talking about software. AI that can write, analyze data, generate images. That's all happening in the cloud. Physical AI is completely different. Physical AI is about making robots and machines interact intelligently with the real world. Think about a robot in a warehouse that needs to pick up packages without damaging them, or a robot on a factory floor assembling components with precision, or autonomous vehicles making split-second decisions in unpredictable environments. All of that requires massive computing power, real-time processing, and training systems. Nvidia is building the complete infrastructure for physical AI. They have DGX supercomputers that train these robotic systems. They have Omniverse, a platform that creates virtual environments where robots can practice without breaking real equipment. And they have edge chips, like Jetson Thor, that fit inside robots, but are powerful enough for real-time AI decisions. This isn't some distant future. This is happening now. And the addressable market is enormous. We're talking tens of billions in revenue potential over the next 5 to 10 years. Now, when we think about Nvidia going into earnings, we have to balance 2 perspectives. Short term is about what happens February 25th, what kind of revenue growth, what margins, what guidance. Analysts expect strong numbers, and I think Nvidia will deliver. But the more important perspective is long term. Is management talking about physical AI meaningfully? Are they giving visibility into how big this market could become? And let's talk valuation and free cash flow. free cash flow is cash a company generates after paying expenses and making investments needed to grow. It's the truest measure of financial health. Nvidia generates massive free cash flow, fortress balance sheet, minimal debt, ability to invest in research while rewarding shareholders. But here's the point. Even outstanding companies can be poor investments if you overpay. Right now, Nvidia is priced for perfection. The market expects continued rapid growth and market dominance. If they execute, the stock could move higher. But if they miss expectations or guidance disappoints, you could see a sharp pullback. That's why margin of safety matters. So how should you approach Nvidia? If you don't own it and you're thinking about buying, I'd suggest waiting until after the call. Yes, you might miss a rally, but you'll avoid buying before volatility that goes against you. If you already own Nvidia, look at your position size. Does it make sense relative to your portfolio? Are you overexposed? If yes, consider trimming and reducing risk. Now let me give you a technical perspective. Right now, Nvidia is trading in the middle of its Bollinger Bands. Upper band is around 195. This tells us if earnings drive it higher, we'd expect movement toward 195 to 200. The setup suggests a modest move on good news rather than a massive breakout unless something genuinely surprising happens. But here's what I want you to think about, and this connects to our next opportunity. While everyone is focused on Nvidia and AI chips, there's another company that's been quietly executing and showing incredible strength. I'm talking about Tesla. And before you roll your eyes thinking this is just another Tesla hype video, hear me out. Because what Tesla is doing right now is very different from what most people understand. Tesla isn't just a car company anymore. Over the last 6 months, while Nvidia has been consolidating and Robinhood has been dropping, Tesla has been on an absolute tear, and there's a reason for that. The market is starting to recognize that Tesla is building multiple revenue streams that go far beyond selling vehicles. They're building an energy business that's growing faster than most people realize. They're building a charging network that could become the standard for the entire industry. And they're building autonomous driving technology that could fundamentally change transportation. Here's what makes Tesla interesting from an investment perspective right now. The company is generating significant free cash flow. They've proven they can be profitable while still investing heavily in growth. And they're doing it in an industry where most competitors are struggling. Traditional automakers are losing money on every electric vehicle they sell. Tesla is making money. That's a huge competitive advantage. But the valuation is tricky. Tesla trades at a premium to every other automaker because the market is pricing in future growth that hasn't happened yet. So you have to ask yourself, do you believe in that future? Do you believe Tesla will dominate autonomous driving? Do you believe their energy business will scale significantly? If you do believe those things, then Tesla at current prices might make sense for a long-term position. But you have to size it appropriately. You can't put too much capital into a stock that trades on future expectations rather than current earnings. That's where risk management comes in. Maybe Tesla is 5 or 10% of your portfolio, not 20 or 30%. You get exposure to the upside, but you're not devastated if the story doesn't play out exactly as bulls expect. And this brings me to the flip side of this conversation. While we're looking at high growth names like Nvidia and Tesla that have performed well, we also need to talk about opportunities in beaten down sectors. Remember how I mentioned Robinhood earlier? Down 25% over 6 months. That's painful if you owned it. But it also creates a question worth asking. Is Robinhood a broken business, or is it just out of favor right now? Robinhood is a trading platform that makes money when people trade. When markets are volatile and retail investors are active, Robinhood does well. When markets are quiet and people are sitting on the sidelines, revenue suffers. Over the last 6 months, we've seen lower trading volumes across the board. Crypto has been less volatile. Retail interest has cooled off. All of that hurts Robinhood's business. But here's the thing. Trading volumes are cyclical. They come and go in waves. And when they come back, Robinhood is positioned to benefit significantly. The company has been investing in new products, expanding internationally, and building out retirement accounts and other long-term features that could generate more stable revenue over time. The question you have to ask is whether the current price reflects too much pessimism. Is the market assuming trading volumes stay low forever? If you believe that retail trading will pick back up, especially if we get more market volatility or if crypto enters another bull cycle, then Robinhood at these levels might be interesting. But you have to be honest about the risks. This is a business that depends heavily on market conditions it doesn't control. Revenue can swing dramatically quarter to quarter. And there's real competition from traditional brokers who have also gone to zero commissions. So how do you think about a name like Robinhood? For me, this is a small speculative position at best. It's not a core holding. It's not something you build your portfolio around. But if you believe in the long-term growth of retail trading and you think the sell-off has been overdone, you could allocate a small percentage of your portfolio and see how it plays out. The key is position sizing. You need to size it in a way where if you're wrong, it doesn't hurt you. But if you're right, it contributes meaningfully to your returns. Now I want to hear from you because your perspective matters. Drop a comment below. Are you positioned in any of these names? Nvidia, Tesla, Robinhood? What's your strategy heading into Nvidia earnings? Are you buying the dip in Robinhood or staying away? Your insights help other viewers and help this channel grow. And here's something important. If you found this analysis valuable, please share this video. Send it to a friend, post it in your investment group, share it on social media. When you share market authority content, you're helping us reach more serious investors who want real analysis, not hype. It genuinely makes a difference. So let's wrap this up. We've covered 3 very different opportunities today. Nvidia reports February 25th. The business is incredibly strong. Fundamentals are solid. Long-term growth story around physical AI is compelling, but the stock is fully valued and expectations are high. Be strategic. Tesla has been executing well and showing strength, but you're paying a premium for future growth that hasn't materialized yet. Position size matters. Robinhood is beaten down and out of favor, which creates potential opportunity if you believe trading volumes will recover. But it's a speculative position at best. The common thread through all of this is understanding what you own and why you own it. Successful investing comes down to patience, discipline, and deep understanding of businesses, not reacting to headlines or timing every move perfectly. Building a portfolio of quality companies, buying at reasonable valuations, and allowing compound growth to work over time. That's how generational wealth is created. That's the market authority philosophy. If you want more breakdowns like this, subscribe and check out our other videos where we analyze companies, discuss strategies, and break down market trends the same clear way. Thanks for being here. Remember, everything in this video is for educational purposes only. I am not a financial advisor. Always do your own research and consult a qualified professional before making investment decisions. I'll see you in the next one.